The materials provided are for information only and do not constitute as an offer. For investment advice, please consult professional advisors. Neither Zach or Jack are financial advisors. The information contained in this podcast episode has been compiled with considerable care to ensure its accuracy at the date of publication. However, no representation or warranty, express or implied, is made to accuracy or completeness. We shall not be responsible for any consequential effect, nor be liable for any direct, consequential, incidental, indirect loss or damage, however caused, arising from the use of, inability to use, or reliance upon any information or materials provided on this podcast, whether or not such loss or damage is caused by us. Links to third-party sites are provided for your information only. The content and software of these sites have been issued by third parties. As such, we cannot be responsible for the accuracy of information contained in these sites, nor be held liable for any loss or damage arising from or related to their use. Investors should be cautious about any and all crypto asset and investment recommendations and should consider the source of any advice on crypto asset selection. Various factors, including personal or corporate ownership, may influence or factor into an expert's stock analysis or opinion. All investors are advised to conduct their own independent research into individual crypto assets before making a purchase decision. In addition, investors are advised that past crypto asset performance is no guarantee of future price appreciation. Do not invest money you cannot afford to lose. All investments come with a degree of risk.
Hello, and welcome back to Unbounded Conversations. We're joined today by an exceptional guest, someone who is not from the BSV space. I think that's the first time we've done that on this show, but someone whose message and focus and expertise are all highly relevant to what we're doing here. I'm proud to say we have Jeff Snider, the CIO of Alhambra Investments, on the show. Jeff, thank you so much for joining us.
Thanks, Jack, for inviting me. Pleasure to be here.
Well, I want to set the stage for you a little bit because I don't know that everybody's exactly on the same page, and I think I can sort of set us off on the journey the right way. So I'm going to attempt to do just that. Something that we've talked about through our work is the idea of a red pill, where it comes from the Matrix. The idea is that people are living in a very carefully crafted narrative, and there's this thing that is a red pill. You take it, and all of a sudden that narrative sort of crumbles, and you can't see the world the same way again. And I think what Jeff offers is a red pill within a red pill. And I know this is a bit of an abstract way to start, but let me add some concreteness to what I'm saying. When you're in an intro economics class, I think you're taught to see the Fed as, maybe you're taught that it's a national bank, maybe you're taught that it has some sort of responsibility for regulating banks. But I think the number one thing that we are all taught in that context is that the Federal Reserve uses monetary policy to influence interest rates, which can be used to stimulate the economy if the economy needs stimulating. And so it's the point of that monetary policy is to sort of even out this business cycle that we've seen and try and make that not happen, I guess. It's probably how I would describe that first view of the world. And then I think there's a red pill moment that happens for a lot of people where they're taught that that's actually not what's happening. What the Fed is doing when they lower interest rates is sort of the equivalent of printing money. And that money printing, not only is it very self-serving, serving the Fed, the banks it serves, and also the US government, but that it's also a very destabilizing force. And that the ultimate destabilization that's going to come from that is massive inflation. I think this latter view of the world is very prevalent in Bitcoin circles because in a lot of ways it's a very self-serving narrative for Bitcoiners. Bitcoin is positioned as a solution to this inevitable problem that we're going to have runaway inflation, the dollar is going to collapse, and we're going to need something, and Bitcoin is or can be that thing. And so, Jeff, I guess a question I would pose to you, somewhat in jest, is does the Fed cure the economy or destroy the economy?
Well, I think your narrative is exactly right, at least as far as, what we're all taught. The expression in the 1980s was to fill in the troughs without shaving off the peaks. That's what monetary policy seeks to accomplish, which is, we don't need recession. We'll use monetary policy to stimulate and influence so that we can avoid recessions or at least alleviate much of the downside. And that by doing so, because Keynesian economists think that recessions are unnecessary, we can avoid recessions or avoid the worst parts of recessions without sacrificing long-run growth potential. That's exactly what the modern central bank seeks to do. And it's a noble sounding enterprise, but the question is, when the rubber meets the road, is that actually what happens? And that's where we start getting into, I like how you put it, a red pill within a red pill. First, we have to examine, does that actually happen with monetary policy? And secondly, on a granular level, what does the Fed actually do? What does monetary policy actually mean? When you start peeling back some of these layers, what you find is, well, sure, that's what they intend to do, but the results are, as you point out, mixed. I think we all know that especially the last decade or so, last couple decades, haven't been quite so good on the economic front or even a financial front either. So already we're into something's wrong. Then when you start going a little further into what the Fed actually does, the whole thing just kind of dissipates into the ether. The Fed really doesn't do much of anything, whether you want to call it money printing, creating bank reserve, whatever. It's not inflationary because the Fed actually doesn't participate inside the monetary system itself.
That's a big statement. The Fed does not participate in the monetary system itself. I think it's going to sound wrong to a lot of people. Can you elaborate on, or how could that be?
Well, we have to go backwards a little bit into the history of the monetary system over the last half century or so. And, again, I know everybody's been taught that the central bank is central, but, back in the 1950s and 60s, there was tremendous monetary evolution, things like Eurodollars, repo markets, things like, wholesale interbank ledger money that began to replace the traditional depository way of doing things. And in the 60s and 70s, not just the Federal Reserve, but central bankers all over the world realized that banks around the world were doing these financial transactions in all these exotic formats that were making it impossible to define, let alone accurately measure money. You have discussions in the early 1970s FOMC talking about how M1 and M2 were already obsolete, and that how they need to transition to an M3 that would probably be obsolete by 1975. So policymakers had a very big problem on their hands. If you can't define money, what do you do as a central bank? Central banks are supposed to target monetary policy or target the money supply. They're supposed to, mitigate the effects of extreme imbalances in the money supply. But if you can't even define money, what do you do? So what the Fed did, and most central banks around the world did over the 1970s, 1980s, and forward, is they decided they didn't have to define money. They didn't need to know anything about the monetary system. What they would do instead is to influence the behavior of the banking system. They'd raise the federal funds rate. In the U.S., it's the federal funds rate. They'd raise the federal funds rate here and there and then signal to the banking system whether they wanted them to create more credit or restrict credit in the case of hiking interest rates. And that's essentially what happened. The central banks, and I know I'm oversimplifying, glossing over a lot of details, but in a very simplified summation of the last 50 years, central banks transitioned, and we're talking a long time ago, in the 1950s, 60s, and 70s, away from a monetary-based policy system into an expectations-based policy system. And so when I say there's no money in monetary policy, it's literally the truth. The monetary system that evolved, starting back at that time, evolved without a central bank within it. That's how, for example, we could have the last 30 years of all of these inflation, all of these bubbles and asset inflation all over the place, with the central bank, the Federal Reserve's level of bank reserves in the system were minimal. Never got to be more than 10 billion into a multi-trillion system that, by the way, expands, it encompasses the entire global monetary system.
When we talk about how the Fed is supposed to influence the money supply, typically we're talking about the Fed funds rate, which is sort of I guess people just sort of substitute in interest rates generally for the Fed funds rate, which is probably already an abstraction too far. But my question to you is, or I'll take a quick aside. I think that a very common issue people have in trying to understand complex systems is confusing correlation for causation. And I think we can say pretty succinctly that there's been a correlation between Federal Reserve interest rate targets and the federal fund rates or federal funds rate. But in your view, is the Fed directly causing that, or is it maybe responding to things that are happening naturally?
Well, in some ways, it's a self-fulfilling prophecy, and that's exactly what an expectations policy intends to create, right? If banks believe, and this goes back to Paul Volcker's regime in the late '70s and early '80s, based on what Volcker did, trying to end the Great Inflation, which everybody believed essentially that if the Fed went to extreme measures, it could do whatever it said it wanted to do. Therefore, everybody believed that if the federal funds target, say, 6% for a federal funds rate, therefore, the federal funds rate is going to be 6%. Why would you challenge the Federal Reserve? Because it can conduct open market operations to purchase or sell into the market U.S. Treasuries or other earning assets to make sure the market meets its market rate. And what I'm saying is that, from the history of expectations policy all the way up until August of 2007, the Federal Reserve didn't do much of any of that. The Federal Reserve didn't have to, because if Alan Greenspan raised the federal funds target a quarter point, the market simply adjusted to that target. It did all the work for him, which again is the entire point of an expectations policy. You get the market to do your work for you. You influence it by creating this illusion that you don't fight the Fed, that if push comes to shove, we can do whatever we want to do, and you don't you dare do anything different. Don't you dare disagree with what we're doing. So when we're trying to establish causation versus correlation, it's strictly a correlation. The Fed said it wanted a federal funds target of X, and the market said, okay, that's what it'll be. But all that started to break down in August of 2007, where no longer were these self-fulfilling prophecy taken as given. In fact, a lot of the a big part of the global financial crisis back in 2007, 2008 was the market saying, okay, we need the Fed to come in here and do something. We need the Fed to stand up and actually enforce some money in monetary policy. And what we found out time and time again was that it couldn't, because again, the system had to evolve outside of the Federal Reserve's control.
Well, the Fed apparently has this ability to print money. And depending on who you ask, printing money should either lower interest rates or raise interest rates. But if they have this tool at their disposal, why can't they wield it? Why do they have to rely on expectations?
Well, because again, they can't define money. Therefore, how are they going to print? Let's be specific here. I mean, let's talk about what is money in a modern monetary format. Alan Greenspan, I think, said it best privately in an FOMC discussion in June of 2000 when he said, we can't define money any longer. The, quote, proliferation of financial products has made it impossible to do so. And what he was talking about was the way in which the banking system itself talks and transacts with one another through these wholesale interbank channels. Essentially, what is money is anything that one bank will dream up that it can get another bank to accept. It's a liability on one side and an asset on the other side. It's ledger money based on balance sheet accounting rules and the accounting paradigm that's in place. So the modern monetary system, again, that spans the entire globe, because this is a global dollar system, not a domestic dollar system. A global dollar system that's dependent upon these what were once called long chains of interbank liabilities that spread all over the world. And there's simply all of these various exotic forms. I say simply, they're very complex, exotic forms of bank liabilities and bank assets. And it can be anything from a simple deposit account. It could be anything from a future deposit account as a forward derivative. It could be a cross-currency basis swap. It could be a regular vanilla currency swap. It can be any number of things that don't actually require money in them. They're treated as monetary because they accomplish a financial or monetary goal, so long as a couple banks get together and at the end of the day, all of their numbers on their computer screen agree with each other. Something monetary happens for reasons or for methods that we can't even see or comprehend.
That it makes a lot of sense that what is money today is very complex, and it would be close to impossible, or certainly impossible with today's technology, for an institution like the Fed to measure it. But I think people would maybe come back and say, well, that's fine that we don't know exactly how much money exists, but isn't what the Fed is creating a form of money that could accomplish some of these goals?
Yeah, and that's, the byproduct of quantitative easing isn't easing, and neither it's not very quantitative either. If you have to do it more than once, it couldn't have been very quantitative to begin with. But the point you're making is right. The Fed does something, right? We know that it has a balance sheet. It reports it every week in its weekly publication, and that amount, as we've seen over the last couple of weeks, has grown exponentially. And so, again, going back to expectations policy, Jay Powell is absolutely thrilled if people think that he's printing money, because that creates inflationary expectations inside of what is growing to be a very big deflationary wave. And so from an expectations policy point of view, the more people don't try to investigate what the Fed does, the better off the Fed is. So what does the Fed do? The Fed buys and sells assets from banks. That's all it really does. And so it creates a bank reserve as an offset for this purchase transaction. And so from the point of view of the banking system, it is selling an asset it already owns to the Federal Reserve in exchange for a deposit balance at the Federal Reserve, or what we call bank reserves. That's all that's happened. It's an asset swap. And so at its best, it's kind of a neutral proposition. I know people say, well, the Fed's balance sheet expanded. Well, the Fed's balance sheet expanded, big whoop. If those bank reserves that are created as a byproduct of what the Federal Reserve is doing in its asset purchase program, then it still requires activation and motivation on the part of the banking system to make that bank reserve into a usable monetary format. And that's what never happens. It didn't happen in the wake of 2007 and 2008, and it's not happening again. So in a lot of ways, when the Federal Reserve increases its balance sheet, that's not an inflationary signal, it's a deflationary signal. It's telling us that the Fed feels it must have to be doing something because of what's going on inside the monetary system that we don't see.
Jeff, it would definitely be helpful for me, as well as I imagine some of our listeners, if we could define inflation and deflation. It's something that I felt, more confident in what these words mean, say 6 months ago, and the more I've learned and listened to you, the less conviction I have in what inflation really is.
Depends on how you want to define inflation. If you want to go full scale Austrian and say it's the devaluation of the currency, again, that the problem that we have now is, what is the currency? It's in very broad terms, inflation, as we're made to believe in nowadays, it's a general rise in consumer prices, and that's a decent definition. But we can argue to the end of the day whether the CPI or the PC deflator are ways to accurately and precisely measure inflation, or whether those things are even possible.
So to be clear, that's your favorite definition, not necessarily any of the specific indexes, but some measure of how much people are paying for goods and services.
Yeah, exactly. I definitely believe that inflation is everywhere and always a monetary phenomenon. So you can look at that as a devaluation of the currency, because if we have to pay more for all of our goods, then the value of the currency is definitely falling. But how it gets from one place to the other is definitely a much more complicated topic and conversation.
Yeah, I think the nature of this asset swap that's happening with the Fed and the banks, which have reserves at the Fed, it kind of gets to a disconnect between, I think, what typical, or I guess normal people would think of as money and what's actually being used as money. Because when you hear the term bank reserve, I feel like it sort of echoes like a bank account. Like, I have my bank account, there's money in the bank account. These banks have a bank account with the Fed, that's their bank reserves. So they have more money when they have more reserves. I don't use a treasury when I go to the grocery store to buy groceries. So that's not really money. No, a bank account is money. A treasury is not money. That maybe is an oversimplification, but I think it gets to why hearing that bank reserves have increased, I think, is so salient in people's minds as saying, like, there's now more money and we should expect some sort of consequence from that.
Well, yeah, and again, what we're missing from that discussion is all of the rest of the stuff that's taken place in the shadows. That's why I call it shadow money. It's shadow money for a reason. Bank reserves, you're right. It's the very name is designed to get people to think of a monetary thing. It's all about managing expectations. But in point of fact, let's assume that let's even assume that bank reserves are a form of money. Let's give them the benefit of the doubt. So the Fed just created, I think, about $1 trillion in additional bank reserves. It's actually $2 trillion in buying. The federal government's balance increased by $1 trillion. So the net result is about $1 trillion increase in bank reserves over the last 5 weeks. However, what we don't see is what's going on in the banking system. And what we can see by what happened in the marketplace, and all marketplace, everything was a fire sale liquidation mess throughout much of March, first half of March at least. What we can tell from that is that money must have been tight in the hidden shadow spaces. Therefore, what we should, even giving bank reserves the benefit of the doubt, what you should realize is that something has gone on in the hidden spaces, in the shadow money system, that was a massive subtraction. So even if the Fed has increased bank reserve by $1 trillion, and even if we consider them money, we also must infer that the amount of money the Fed is adding, this other kind of money the Fed is adding, probably isn't as much as been subtracted out of the shadow system. So already we're starting in a deposit. I think that's where people really start to get it wrong, is they think that the Fed is starting from zero. It's adding to the system. It's adding into its own balance sheet. But its own balance sheet does not define the entire monetary system. And as I argue, the Federal Reserve's balance sheet is a very minuscule part of the global shadow money system. So again, what we're talking about is a problem in the hidden shadow money space where money kind of destroys or disappears from it. And the Fed comes in after that destructive behavior becomes visible in the marketplace and adds this other form of bank reserves in a very bureaucratic, rigid way that, by at the end of the day is more of a byproduct than effective monetary addition.
Yeah, so I think a component of this, or let me put it like this. Why would anyone want to lend money to the U.S. government?
That's a loaded question if there ever was one. I know where you're going with this. There are U.S. Treasury bonds, notes, and especially Treasury bills have utility outside the investment and credit characteristics of the issuer behind them. And I know, we look at the U.S. government, it's the brokest institution that history has ever possibly conceived. It's getting broker by the day and seemingly in an exponential way. Therefore, people, bond vigilantes, where are you now? And people are trying to figure out, well, how the hell can the price of U.S. Treasuries continue to go up and up and up? And again, that gets back to the shadow. What's going on in the shadow monetaries? The price of a Treasury bond, the price of a Treasury bill, they're telling you something abnormal is going on in the hidden shadow money system that's driving the participants inside the shadow money system into these various instruments, regardless of the creditworthiness of its issuer. And the reason is because there are utility in these securities that go beyond, strictly investing in U.S. Treasuries. Even at a negative rate, there's utility in a Treasury bill. And that utility is repo collateral. Repo is the lifeline behind this world-spanning monetary system. And you have to have collateral to participate in that system. And you also have, at times, collateral isn't as easy as it seems to be. It sounds like, okay, in a repo is nothing more than a collateralized interbank loan between two counterparties, usually overnight. You post some collateral, I give you some cash. It's that simple. But it's actually much more complicated than that. And so there are times, again, when the value and utility of the safest, most pristine forms of collateral skyrockets. And it's exactly the same way, and it manifests in exactly the same way as any kind of bank run, where the price of, say cash during the early 1930s, skyrocketed too.
So let me do some summarizing so that we can sort of plunge forward. We've sort of stated that what the Fed is doing is not equivalent or even related to increasing the money supply. They're playing an expectations game. And these treasuries, whose prices are continuing to go down,
prices are going up. Yields
sorry.
Yeah.
Yields are going down, prices are going up. Prices keep increasing, and on its face, it seems very strange because you're lending money to a institution that is going more and more into debt. But it can be explained when you realize that these treasuries have utility beyond just the loan.
Right, and their utility is based on the shadow money system. And so it's another bank-centric idea that goes in, okay, why are these things happening? And it's not readily apparent to, the layperson on the street. Why are these things, what is the utility of a Treasury bill? I don't understand why anybody, as we saw in March, some of the Asian trading numbers for Treasury bills were, minus 20 basis points in yield. And that doesn't make any sense. Why would you sign up to lose money? And the answer is because you want to survive until tomorrow, and you need the best form of collateral to keep your balance sheet liquid. And so the Treasury, and not just Treasuries, German bonds, JGBs, all these government bonds are a form of bank balance sheet utility, not investments. And when you start to realize that things like U.S. Treasuries have a monetary utility, then you start to look at them beyond their investment characteristics, and it starts to make sense why these things behave the way they do.
I think it's a good time to maybe turn our attention to the Great Financial Crisis or Global Financial Crisis 1, and what went wrong then, or what's wrong. I think everyone feels like there's something wrong with the system, and something about this isn't working, and that was a major point of failure. So what happened then?
Well, that's not an easy answer, but the easiest part of that answer is it wasn't subprime mortgages. Subprime mortgages were a very, very small part of the financial crisis. And it gets back to what you were talking about earlier and the whole point behind cryptocurrency in the first place. I think there's the pervasive belief is that, this stuff is inflationary, but what really is driving a lot of unease and angst is that the system that built up, this monetary evolution of shadow money, as I call it, was unstable, not necessarily inflationary. It was inflationary up until August of 2007, but it was really unstable. And I think that's the sense that I think you and I and everybody else are sharing, even if they can't put their finger on it because this is a shadow system. Everybody realizes that it's an unstable system. So what happened starting in August 2007, was that participants in the shadow money system, which were largely the financial system, banking system, started to realize the inherent instability of the way things were done. And oh, by the way, especially on August 9th, 2007, it became clear that the Federal Reserve really wasn't a part of it. And so, to oversimplify it, before then, it was thought that this was a very low risk system where you could just expand and do everything crazy and stupid on your balance sheet like subprime mortgages, and that there would be no downside to it. As the housing bubble started to reverse late 2006 and throughout 2007, it began to dawn on people inside the system that was all stupid and crazy, that it wasn't, in fact, unstable, and therefore the risks involved in being a big part of that system were much larger than anyone had anticipated. Again, it didn't have much to do with subprime mortgages. It had to do with the fact that a shadow money system with no central bank backstop is an inherently dangerous place to operate, as was proved throughout the rest of 2007 and into 2008. And what made it a global financial crisis was, again, the fact that this unstable monetary system that was falling back in on itself with no way to arrest the decline expand the entire globe. It wasn't just the U.S. system. It wasn't just Wall Street. It wasn't just irresponsible Goldman Sachs or Citigroup. It was all of these global banks that had participated in this Eurodollar system for decades, thinking that there was no downside. And then when there came to be a downside, it was lights out because there was no way to stop it from imploding.
Everything there makes a lot of sense. But I think the one thing that maybe requires further examination is why this system is inherently unstable. Because, you would think that the sort of participant banks, they are all trying to not go bankrupt, make money, and if the system falls apart or is unstable, that hurts their business. So shouldn't their incentive be to act in a way that results in stability?
Yeah, and that's the traditional capitalist system, right? There's a brutal discipline involved in keeping everybody in line. But if you start to believe, again, going back to expectations policy of the Federal Reserve, that there's this thing called the Greenspan put, and couple that with the idea of moral hazard, you can eliminate a lot of that brutal discipline because people don't really believe there's any downside to it. And so that softened the really hard edge that should have kept the global monetary system in line. Again, it's a global monetary system in line because, everybody just, a lot of confirmation and recency bias. Nothing bad had happened, therefore nothing bad will happen. And by the way, if something bad does happen, Alan Greenspan or Ben Bernanke will fix it for us. And so that's why a lot of that some of the natural processes that should have been a governor or limit on the risk-taking behavior that took place during that time, they were missing, sorely missing. And the thing is, you can't put the horses back in once they're let out of the barn. You can't put the toothpaste back in the tube. Once the participants realized that this thing was riskier, that their survival was at risk, Bear Stearns and the like, they didn't want to do the same things that they did before. And so the monetary system, without the banks supporting it, began to contract. And it began to contract and fail in ways that everybody inside the system had previously thought were strengths. I'll give you an example. Repo was thought to be a redundant system to the unsecured wholesale interbank market. That's what federal funds really is. Federal funds, or whether it's Eurodollar deposits or any of these other types of unsecured interbank formats, everybody thought, well, if you get shut out of the federal funds market, you can go to the repo market. Well, you got to have collateral to go to the repo market. And prior to August of 2007, you could use almost any collateral to do so. So if you have a portfolio of securities, you're funding them in the federal funds market on an unsecured basis, or issuing commercial paper or any kind of unsecured whatever, you've got that portfolio of securities at your disposal to go into secured repo market, because the repo market will always take security, it'll always take collateral. That's what everybody believed. But as it turned out, the collateral system imploded in on itself too. So participants who used to be using subprime mortgage or even prime mortgage bonds as collateral in the repo market found that, okay, where I'm getting shut out of commercial paper, I'm getting shut out of federal funds, I'm getting shunned in Eurodollar futures. All I've got is prime mortgage bonds in my inventory. I want to go in the repo market as my final backstop, and it won't accept my prime mortgage bonds as collateral because those are now being repudiated too. And so, it was a lot of things that were assumed to be true, that redundancies were a strength, when it turned out that these redundancies were actually bottlenecks that created snowballing problems upon themselves. And it all related to this idea that the system was inherently safe when in fact it was inherently unstable. And the reason it was unstable is simply, again, as you pointed out, that risk-taking behavior got out of hand for a lot of different reasons. And in that way, even though what we're talking about is shadow money and wholesale interbank stuff that doesn't sound like it's most people understand what's going on, it was the same kind of behavior you've witnessed throughout history in any kind of monetary expansionary period.
So I think something you said earlier about banks being primarily concerned with surviving till tomorrow, and that at the end of every day or every quarter, in varying capacities, everyone has to make sure that everything adds up. And as people's sort of evaluation of risk changes from day to day, making everything add up can become easier or much more difficult at certain points.
No, I know it's exactly true. You think that it should be very easy if you're running a portfolio of securities, which, banks, modern day banks, especially larger banks, are nothing more than hedge funds. They're not banks in the traditional sense. And that's probably, another topic of discussion, if not today, then some other time, where, banks are not the way they used to be. They're not just strictly depository institutions where they take in, stacks of cash and put it in a vault and fractionally multiply those cash reserves into deposit liabilities and loan assets. That's not the way banking system works. When I talk about wholesale shadow money, it is not just a monetary evolution and revolution. It is a banking evolution and revolution too. And it took place a long time ago. That's what Lehman Brothers was. That's what AIG was. That's what Bear Stearns were. These were not depository institutions. These were these modern wholesale funded types of banks.
Well, these banks have this very complex operation to sort of execute on a day-to-day basis. And so they probably, and this maybe is part of why evaluations of risk can change very suddenly, they're not able to think too far into the future in terms of how things could change adversely against them. Do you think the fact that U.S. Treasuries are the most liquid form of collateral sort of spells some kind of huge future threat for the system?
Not specifically. I think that's a good point, because a lot of what we're talking about here in terms of how banks manage their balance sheet and how they construct their balance sheet is all about looking at future risks. Now, whether they can do it accurately and reasonably is another question entirely, because history has shown that it's very, very difficult, if not impossible, to model especially risks, jumps in risk. The old risk jump diffusion model from the 1970s has still been proven to be an accurate way of describing the world as it is. And so but you're right, banks are always looking at future volatility, modeled volatility, implied volatility. It's always what they're looking at. And right now, U.S. Treasury liquidity risks are probably last on the last line in the catalog of things they're thinking about, because there is so many more immediate and apparent things for them that would impede balance sheet construction and fluid balance sheet dynamics today than that would be.
Yeah, I think talking about things on this scale is very challenging, because in a sense, I think what a lot of people who are, I guess less optimistic about the future value of these treasuries, what they're sort of implying is that if that is the most liquid collateral and the safest collateral in the system, then the system is at some point going to be operating with a set of collateral that's worth a lot less than it's worth now. And I think I don't know if that's true, but I also think that if it were true, it's kind of hard to wrap your mind around the idea of everything being worth less all of a sudden, and what that actually means in the real world in terms of how we go about living our lives and what is produced and what people's expectations of their own wealth and their future prospects are. It's just a really difficult leap to make in terms of thinking about the economy and thinking about how money and our monetary systems impact that. I don't know if I admire you for your diligence and clarity on just describing the system as it is, which is clearly not easy to do, and also not something that many people who are outside the system or maybe even inside the system bother to do. And so I think, in that sense, what you're offering without even maybe sort of prognosticating on how or if this system ultimately implodes, it's a huge value you're adding. But I am curious, I guess, to sort of dip our toes in that part of the world, or part of this conversation, which is how, if there's inherent instability, how does that ultimately manifest, and where do we go from here?
Well, the one thing it does, it drives up the value of U.S. Treasuries and government bonds. I know it's almost contradictory and counterintuitive, but that's, the way the system is designed is it gives these things primacy. And it's not necessarily primacy because the U.S. Treasury says so, or the president or the Congress or anything like that. In the repo market, let's just consider this as a very narrow case of the repo market. In the repo market, the bank utility of collateral is all about the counterparty who has cash. What will they accept as the best form of collateral? And if you're lending cash and accepting collateral in return, all you care about in the collateral that you're accepting in return are the liquidity characteristics of tomorrow, should you have to sell that collateral if your counterparty defaults on the cash loan. And so, we don't care about whether the government's broke or when it's going to go broke, if it can issue treasuries 13 or 15 or 20 years from now. All the repo market cares about as far as collateral is there a liquid market for tomorrow where if I have to sell the collateral because you've defaulted on the cash part of the loan, I can get a reasonable bid or at least a reasonable price for the collateral as I sell it. And right now, the marketplace, the most liquid markets are all government bond markets. Doesn't matter that the governments are all broke. The markets are all liquid, and they're liquid and crisis tested. Even last month, OTR treasuries were perfectly liquid throughout most of the crisis. In fact, they're the only place that was liquid throughout the crisis. So the more unstable the system gets, the more we question about shadow money, the more we wonder what the hell the Federal Reserve is doing. It drives up the price of those forms of repo collateral.
So, Jeff, if I'm understanding you correctly, then when or if this, kind of pops, it's going to be especially fast and violent, right? Because it's basically going to, that's the characteristic of most bubbles, but it seems like because of the repo markets and central banks' role in perpetuating the existing repo system, it seems like it's going to be kind of like Treasury bonds are going to maintain and increase their value until kind of like one day it all massively declines even more quickly than other bubbles. Would that be your characterization?
Are you talking about the treasury market, the decline in the treasury market?
Yeah, I'm not just for U.S. Treasuries, but to a lesser degree also government bonds of other countries.
No, I think we have a pretty good example in the Japanese case, and again, it's a pretty good analog. I know people don't like comparing Japan to everyone else, but yet here we are following along the Japanese case because everything is that similar. It's not necessarily the case, and I don't expect it to be the case where you see treasury bonds, the treasury market just blow up, and that treasury bonds at some either near or intermediate point in the future are no longer priced and negotiable. In fact, in the same way the U.S. dollar. This is an unstable system that needs to end at some point, but that doesn't necessarily mean the exchange value of the U.S. dollar goes to zero. In fact, I would argue it's the other way. The U.S. dollar goes up. That tells you that there's a liquidity problem in the shadow money system, the global part of the shadow money system. And so you can envision a scenario which is playing out right before our eyes, where as closer to its endpoint, and again, I'm not saying we're close to the endpoint, but just hypothetically speaking, closer to its endpoint, the value of the dollar skyrockets, as does the value of U.S. Treasuries. And that what ultimately fails is not the Treasuries or the dollar, but it's the monetary system itself that demands some kind of intervention that takes place before any of those kinds of scenarios that you just talked about actually happen. In fact, I would say that's probably the likeliest case. The rising dollar is nothing more than it's kind of a squeeze, a monetary squeeze on the global economy. So as long as the illiquidity, the bank-centric system continues to squeeze, you're going to have the dollar go up, and you're going to have the value of U.S. Treasuries go up too.
What potential catalysts do you see for that system to stop?
Well, I would have thought it would have been the global financial crisis in 2008, but that didn't prove to be the case. It's almost more of a political or social question than it is one of money and finance. Here we are. It's April of 2020. And we're experiencing a second global financial crisis, and yet hardly anybody's talking about these things. So it's really, to me, it's a level of how long are people going to be able to hang in there and put up with this kind of dysfunction and the costs of this dysfunction, which are, in a deflationary scenario, they're always in the labor market. John Maynard Keynes was right about that. The worst monetary evil is deflation because of what it does to the labor market. But yet we've had this labor participation problem in the U.S. and around the world that goes back to 2007 and 2008, and yet there's still tolerance for the Federal Reserve. There's still people who are willing to believe that Jay Powell is actually printing money and that he's got everything under control. And so I think it's more of a question of, at what point does the social and political instability, which we've already seen bubble to the surface, even before this year, where those things become too much to manage, that people start asking the right questions about, what does the Federal Reserve actually do? Is it inherently what it says it is? That we start to get to potential solutions before it gets to be too bad.
That makes a lot of sense, and I hope it doesn't come. Or let me posit that I think an alternative way that I'm at least optimistic is an option is that some sort of alternative system develops and we see more of a diminishment of the sort of importance or at least sort of, even if the internal logic of the current system perpetuates, that it diminishes in importance and value relative to some other system that could emerge.
Yeah,
to me, that would be the most peaceful way of resolving this.
That's the question right there. I mean, you've hit the nail exactly on the head. This is really a two-part process. What I do is really the first part, which is trying to get people to identify and understand the problems that exist today. Let's say in isolation that we're successful at that, and we get people to understand the Fed's not really a central bank; it's more of a domestic bank authority. It's very limited in its utility. Why is the repo market such a mess? What is wrong with the banking? Let's say we accomplish all of those goals. Well, then what? It's not okay. We've got a system that's broken. How do we fix it? And you're exactly right. The other part of that is, where do we go next? What is there that can potentially take the place of an unstable bank-centered shadow money system? And I think the answer is the exact opposite of all those things. A very visible, transparent monetary system where the rules are front and centered and very well defined, so that we shouldn't have to spend an hour explaining just the first chapter in the book on money. It should be that was one of the most elegant parts of the gold standard, the classical gold standard, was that everybody knew what the rules were. You had a gold coin in your pocket, and you didn't need anybody to explain to you what the hell monetary policy was. That's what we need to work toward, an open, transparent system, but that can mimic some of the good parts of the current system, which is fluidity, efficiency, the way that it can easily translate these various disparate systems all over the globe. That's what made the Eurodollar the world's reserve currency, is the fact that it could intermediate between very different systems and allow globalization and trade. The problem is it did it in the shadows. It did it without any kind of regulation or oversight, which meant it could easily go way too far, as it did. But now the pendulum has swung too far in the other direction, where we had, before 2007, it was a hidden shadow money system that was doing too much, to now we have a hidden shadow money system that's doing way, way too little. So, it's okay, we got to recognize the instability of the shadow system, but then we have to have, you're right, an alternative to that system. And in fact, having an alternative, a realistic, viable alternative, makes it that much easier to transition, and maybe that much more likely.
To bring this to Bitcoin for a second, it's actually very ironic to me, which a lot of things in Bitcoin are, which is that the sort of common view of Bitcoin is that it's very, very inefficient. But on the bright side, there's only 21 million of them. Actually, if you break it down into its component parts, it's 21 quadrillion, I think. But,
right.
Colloquially, we say 21 million, and therefore what the sort of playbook is that even though we're not going to actually transact on Bitcoin and we're not going to take advantage of the Bitcoin ledger, at least we have this Bitcoin thing that can sort of go into the vaults of central banks the way gold once did, and we can return to a sound money future where we are, if you're a Bitcoin holder, you're very rich. And to me, well, the fundamental flaw in that thinking is thinking that Bitcoin is inefficient. But the second flaw is that now you're sort of setting yourself up to replay history. Not that that would ever happen, that sort of scenario. But if it did, look at what happened to a gold standard. Look at what happens when things can move into the shadows. I don't see any real reason to think that there's anything special about Bitcoin as a scarce asset that would lead to a different outcome. To me, what has promise is the fact that we have a highly efficient but highly transparent, in fact, fully transparent system that can serve as a new basis where you can actually see what's happening. And that's the real value. I think the sound money component, the predefined rules in terms of what is Bitcoin, how many Bitcoins are there, when are they going to be mined, that's an important component. But without that transparency that comes from having a highly efficient ledger that can be used to record transactions, not just the transactions of Bitcoin, but also things like the transactions of equities and derivatives and bonds and anything, the ability to actually look at the system, at least if you want to look at the system, or, some of these things can go into the shadows through encryption, but to a lesser degree, but also there can be political will to keep things out of the shadows. And, if you're not using encryption, or at least limiting the use of encryption, then you're able to get a really, really strong and complete view of what's actually happening, which is something that's been, I think sorely lacking and has led to a lot of instability.
Yeah, I think you're right, because as soon as you get to even just a little bit of shadows, there's always going to be the incentives for going too far, or stretching rules, or taking it to the limit. And if you have no ability for the system to reject that kind of behavior, it will simply grow and grow and grow. I mean, the Austrians call it Cantillon effects, and recognize that for a reason. If you privilege banks in society, in the monetary system, they're going to benefit first and foremost. I mean, that's exactly what we've seen with the shadow money system. The rise of the global bank over from the 1950s, 60s forward to the middle 2000s was, it was unstoppable. And the reason it was unstoppable was because of the fact that nobody really knew what the hell was going on. And I think you're right. The answer to correcting that isn't necessarily limiting the supply of money. It's in hard, fast rules about transparency, predictability, and, I would argue also easily understood. that's to me, that was the best part of the classical gold system, because the monetary system and the gold system wasn't fixed either, but it was simple. It was largely transparent, and nothing's perfect. But because it was simple and transparent, it allowed it to do all of the things that, all of the positive effects of a sound money system. And that's, I think, what needs to happen. What replaces the Eurodollar system should be not necessarily the exact opposite, but the exact opposite of its worst qualities, which are an open and transparent system. And you can see it in things like repo collateral. Like I said, the repo market, and especially on the collateral side, is far more complex and dizzying and hidden and shadowed than even what goes on in these other marketplaces. And you can see where Bitcoin, blockchain technology, I'm not the biggest expert in those kinds of things, but I can see where those things would be valuable in bringing some of these collateral issues to daylight, like, proving provenance of a piece of collateral. It hasn't been borrowed from X, Y, or Z. It hasn't been transformed. It hasn't been repledged or rehypothecated. That kind of a thing where we could create a sort of quote unquote clean repo market as opposed to the dirty hidden repo market that operates today. And you have to think, Gresham's law over time, this clean, open, transparent repo market that's operating on some kind of blockchain technology where everything is all out in the open will win out, and it will drive everything out of the dirty repo market. And then we could transition to something that is more of a sound money, even a sound money repo market. It maybe is as absurd as that sounds.
No, I don't think it's absurd at all. And I actually think Bitcoin can be used even to just promote the sort of health and transparency of the existing system. It doesn't have to be Bitcoin denominated. Bitcoin as a database, what it provides is a public, time-stamped, immutable record of ownership. And you can do with that what you will. The first use case was for tracing the ownership of Bitcoin tokens, but you can trace anything with that technology. And so, tracing US treasuries would be, an obvious application, or having some sort of on-chain central bank digital currency, which you can trace the ownership of. There's a lot of possibilities. So it doesn't have to be a world with prices denominated in Bitcoin to be a financial system built on Bitcoin.
Well, that's an interesting point, because in one sense, that's what this Eurodollar system already is. It's just denominated in US dollars, but there's no US dollars behind it. They would just call it US dollars, and using the US dollars allows all of these bank nodes, which are nothing more than a computer network, a computerized, global bank financial network, to translate and talk to each other. We just denominated in US dollars because that was the easiest thing to do, given the way the system had transformed out of the Bretton Woods era and paradigm. So, I think, in a lot of ways, the Eurodollar is like a cryptocurrency. It is a distributed ledger where all the good guys are these banks that operated within it. And it is, to some extent backed by central banks, but it's really, economist Paul Samuelson in 1971 was right. He called it benign neglect. Central bankers and government finance ministries, the U.S. Treasury Department, they've all kind of turned a blind eye to how the monetary system works because they were convinced that it just works. And so long as it works, what do we care whether it's denominated in U.S. dollars or not? I mean, yes, there's a privilege to having a denomination, but it's not what everybody thinks, and it's more of a burden than anything else. So there is, I think we've already moved, whether people realize it or not, we've moved in that kind of a cryptocurrency, ledger technology direction a long time ago. And it may not be as difficult of a transition as it may seem right now, because most people don't realize that this shadow money system exists anyway.
Yeah, and fortunately and unfortunately, I guess at the same time, I think what it's ultimately going to take is consumer demand. People are going to have to want to see what's happening, or want the ability to see what's happening. And I think we're very far from that. And I also don't have very much faith in sort of a top-down, government-led initiative to make what's happening in the financial system extremely transparent. To me, that seems unlikely. It seems like it has to be something that comes from citizens and comes from consumers of financial services who, I guess, need to hear messages like this to understand that being able to see what happens in these shadows is very important to their long-term well-being.
Yeah, you're right. There's a tremendous amount of institutional inertia, and there's massive incentives for the status quo. In fact, everything is designed to maintain the status quo because, I mean, we don't have to assign nefarious motives behind all of these people. The Federal Reserve isn't evil; it's just wrong. They're trying their best according to their own paradigm and their own way of thinking. They actually think that, hey, we're trying to keep the system maintain the system because we believe this is the best possible outcome. They really believe that. I mean, Ben Bernanke was a really smart guy. He was so rigidly ideological, he couldn't see that it wasn't the best way of doing things, and that the Federal Reserve is not what he thought it was. So, you're right in the sense that, a top-down kind of a solution is probably not a most probable case here, and that it's going to have to come from someplace else. But it's not necessarily the case where it can't be top-down. Maybe the top-down has to be driven by some kind of external pressure. But we saw it with Bretton Woods. I mean, whatever you feel about Bretton Woods in 1944, yeah, it didn't last all that long. But for its own purposes, it was a top-down solution, and it was a rather elegant one, given the constraints of that period. So I don't want to shut off the top-down solution completely. I mean, we could have a Bretton Woods 2 tomorrow, if we can get people to understand the nature of the problem as it actually exists. But I think you're right. It's not going to be Jay Powell and Christine Lagarde who are going to get together and say, "Hey, we need to reform the entire global monetary system." They're going to be the ones that have to be told, "Hey, we're doing this with or without you."
Exactly. It could be a top-down solution, but I think it's unlikely to be a initiative that comes from the top.
There's almost no chance that it's going to be an initiative from the top. It's got to come from somewhere else, and it's probably not going to be. I mean, the way I think that economics, especially central bank monetary ideology, is so rigid that it's probably going to require a complete, throwing them all out and starting, redefining what a central bank job actually is, and probably you need to, start from scratch in terms of those kinds of things too. So, I don't think Jay Powell or his successor are going to be involved in, Eurodollar 2.0 or whatever comes next. It's not going to be these people.
Probably for the best.
Yeah, their track record is not very enviable when you sit and analyze it. Again, I think that's why are we sitting here having this conversation is because your audience knows this and my audience knows that something isn't right. People have known, and it's not just COVID-19. Obviously, it's not just the most recent events. Ever since 2007, something isn't right. Why is the labor participation rate so low in the United States? What is going on? There's something going on. And nobody seems to have any answers. And furthermore, nobody seems to want to ask any questions. We're just supposed to take it on faith that all of these things are being covered when, time and time again, we see all of these oddities. Why are U.S. Treasury prices continually going through the roof? It doesn't make any sense. So we can tell there's something wrong. We can tell the system is unstable. But, most people lack the ability or the framework or the ability to interpret what they see around them and put a name and a face on what that instability actually is. And that gets back to institutional inertia. I mean, central banks have a vested interest in people not understanding what they actually do.
Well, Jeff, I don't want to take too much more of your time. And I also think to continue to fill in the details, I would point anyone who's listening to head over to check out the market research. You tend to post almost every weekday, if not more than once. And what's the link where people can find your work?
You just go to alhambrapartners.com, and I usually have a couple of pretty detailed posts filled with charts every day. Some of it's about current topics, what's going on in the world, and some of it's more of these in-depth dives into the shadow money world.
It's an excellent resource, and I think especially if you like visual aids, you guys have a lot of great visual aids there, which can sort of add some pictures and graphics, which can help to illuminate some of these topics. And Jeff, you're about a month into, I would say, a new initiative called Eurodollar University. What can you tell us about that?
Well, Eurodollar University intends, when we get it up and running and get it completely going, it intends to fill in these blanks, to be in a one-stop resource to all of these shadow money. And call it Eurodollar University because Eurodollar is this global offshore U.S. shadow money marketplace. So as we get going, there's a couple people who I'm working with, including those at Alhambra, to try to give people the resources, the ability, the framework to understand all of these various pieces that point to this instability in this global system.
Well, we'll be among your customers, and I would point everybody also to Making Sense, which is not the podcast done by Sam Harris, who we will not speak further about. It's a better Making Sense about these topics, and so check that out. Zach, anything else you think we should touch on?
I guess just one question for you. It's kind of a speculative question, but assuming you take our word for it, at least for the purpose of this question, that there's a blockchain right now that is scaling really fast, and that in a number of years we'll be able to very cheaply, securely, and in a very fast manner be able to say store kind of potentially all financial transactions of repo markets, of treasury markets. If you take us at our word that technology exists now and will continue to improve, what would your kind of recommendation be for, say, our average listener to try to make that happen? I know it's a big question, and we talked a little bit about how it's going to probably take a long time. It's going to be hard. It's not going to be quick. But for those of us that both care about Bitcoin's rise and kind of what a world where we're storing data on a ledger where we can really trust the information, and that also care about having more transparent, a more transparent government and understanding of our global financial system, what can we do?
I'm not sure what we can do at an individual level other than, act skeptically about what's going on. But by the way, I think you guys are exactly right. Whether that technology exists today or not, I mean, that's a question. But I have faith, and I actually believe that technology will exist. When, I don't know. I mean, you guys probably know that better than I do, and you definitely have a better idea of what that looks like. But I have a tremendous amount of faith that will actually happen at some point. And I also have a tremendous amount of faith that will be an elegant, maybe not seamless transition, but offer maybe the best opportunity to transition from where we are now into something that follows that is stable. Because I think that would allow an open and transparent, much more stable system to exist down the road. Now, how do we push for that kind of a transition from one place to another? Other than lighting your torches and getting your pitchfork and running on down to Washington and picketing the Mariner Eccles building, I'm not sure how you do that. Other than to continue to question what you're hearing in the financial media or what these central bankers continue to say, and get together and encourage other people to read and think and not just swallow the red pill within the red pill kind of a program. To really think about these things and to understand that, your intuition, this idea that something isn't right and hasn't been right for a while, is probably a correct one. Your gut instinct is you should probably think about that. And the more educated people become about shadow money, I think the more abhorrent it will be to them. Because it is, in a lot of ways, it violates all of the basic tenets of money and finance and banking. And yet it's been allowed to grow and fester and then, fall apart for a very long period of time. And it does impact everyone's daily life. And it impacts not just through, the stock market or something like that. It impacts the global economy, the lack of economic growth the last 12 years across the entire world. And there has to be a way for us to be able to push forward into something outside of that. I'm not sure how you do that on an individual basis other than education and self-education and knowledge.
Thank you, Jeff, so much again for coming on.
Sure.
We have a lot of respect for what you're doing. I see echoes of, we're on sort of a mission to try and teach people that Bitcoin is actually efficient. And sometimes I think there's a lot of self-repetition, but, it's just important to keep putting that message out there because you never know who's going to hear it when. And so we appreciate you retracing your footsteps with us here today.
Yeah, and I think we're actually coming at the same thing from maybe different directions, which is always good because when you get together, you can do much more things together than you can by yourself.
Absolutely. All right. Well, thank you guys for listening, and we will talk to you guys again soon.